Right.
Hey everyone, I am back with Nick Murch. Nick Murch is back on the channel, portfolio manager from Purpose. We're going to talk about these new yield share launches that happened on the 20th. How are you, Nick? Thanks so much for coming back.
Yeah, that's great. Thanks so much for having me on. Really excited to be here.
It's my pleasure. And in case I'm sure most of my audience knows this already, but you guys have just launched quite a few more of names in your yield share suite. So you launched a Costco one, Netflix, Broadcom, Coinbase, Palantir, United Health Group, and also kind of like an all-in-one sort of. You have this one here, the Tech Innovators, the YMAG yield shares, which includes several of them, including basically the Magnificent Seven plus Broadcom. So just in case my audience is kind of newer to these, can you explain what these are real quick here and maybe summarize it for us?
Yeah, absolutely. So just to kind of take a little bit of a step back and really go over what these products are
Yeah.
and why we really created them. So we looked at the market and we saw a pretty large gap for those looking to really mix some capital appreciation and income. And what we saw was some of these triple levered products or products with really complicated derivative strategies that can actually be very harmful to the average investor. For instance, if you think about some of these highly levered products, people don't understand that the leverage is rebalanced daily. And if a stock goes on a streak of really bad runs, you can drastically underperform and not really get the desired effect, which is long-term appreciation. And what we set out to do here was really create a product that mimics the total return profile of the underlying while generating monthly yield. And the way that we do this is through owning the underlying directly, then layering in a 50% covered call strategy and adding a moderate 25% leverage. And when we were backtesting these models, this
Mhm.
really provided to be an effective way to farm volatility and generate yield with a real focus on the total return profile over a longer period of time. And we also hedge this back to the Canadian dollar, and we combine all these operationally intensive features into one very simple and easy to use product. And the way we like to think about it, and an analogy that Canadians like as well, is this is a way to earn rent while housing your favorite securities.
Right. So a lot to unpack there, and we've discussed this before because you've been on and we've talked about these products before. So essentially, this is one ETF, or you have several in the suite, but they only hold one stock. So you guys actually
Yes, that's right.
hold the underlying, whether it's the Netflix one or the Costco one or Nvidia, Microsoft,
Mhm.
et cetera. And then you said covered call writing 50%. So that means,
Mhm.
just to recap, up to 50% of the portfolio, you write covered calls on it.
Yes, that's exactly right. And we found that that was a really proper ratio because what that did was you had some of these other covered call strategies that were 100% covered call
Yeah.
strategies. So what they had was a lot bigger yields on the brochures, but by doing a 100% covered call strategy, what you do is you give up away a lot more upside over the longer period because you can get called away to a much higher degree. So that's why we found that 50% ratio was a really perfect blend of gaining very attractive monthly income, but at the same time, really participating in that long-term growth profile.
Okay. And these are, we talked about the covered call strategy before because it's very important. You guys do
Mhm.
different legs to you're writing mostly out of the money, I believe, but there's different calls at different strike prices out of the money. So even though you're writing on only 50% of the portfolio, which means up to 50%, which means half of it's not even touched with covered calls, it's fully participating in what that underlying stock is doing. But the other half, you have some out of the money calls as well, which I really like your website because if you go to you could actually see the legs of the calls there. So maybe just quickly describe Purpose's view on covered call writing and the moneyness of these covered calls on these.
Yeah, I think you've really hit the nail on the head in terms of one of the incredible features of our product is that proprietary option strategy.
Hmm.
So at any given time, we're going to have anywhere between 10 to sort of 12 different legs of options underwritten on the securities. And what this really does is limit our risk to path price dependency. So in certain periods, you can get the stock really kind of appreciating very quickly and the stock price can run away. But because we have all these different legs written at different maturities, what that does is really limit the risk of getting called away in any particular event. And with a lot of the volatility that we're seeing, especially around this earnings period, this is really important because you have to have a little bit more sort of diversification in the option strategy itself.
Yeah.
And this laddered maturity, what we're doing is we're targeting anywhere between 2 weeks out to 8 weeks out on the options chain, and the average maturity is around 30 days. And in terms of moneyness, we're going in between at the money and then 5% out of the money calls. And what we're doing here is really picking up a lot of the yield where we think the volatility is mispriced.
Awesome. And all of these have 25% leverage as well. We've discussed this in previous videos as well. So why that 25% leverage? From what I've been told by multiple fund managers who use that amount of leverage, it's to really get approximately the same type of performance. Because we know when you're writing covered calls, you're kind of limiting that upside. So when the stocks go on a run, you're getting a little bit less upside, but that 25% yield really helps kind of get you the same approximate performance of the actual underlying stock while still getting that monthly rent that you're talking about. Is that pretty
That's
much
exactly
correct?
right.
Okay.
Yeah, I couldn't have described it better myself. So when we did a lot of our back testing, that blend of that 25% leverage with the 50% covered call really helped to track the underlying security much tighter. So what this does is really help us participate a lot on the upside. And I think that you can backtest a lot of these models and you can kind of play around with the ratios.
Yeah.
But until the products are in the market and performing, that's when you really can see the unlock. So all of these products that we have before the launch today have been in the market for quite a while now, and the returns profile have really mimicked exactly what we were back testing and even exceeded it for some of the products like Amazon. We're outperforming pretty drastically the underlying security. So you can backtest all you want, but until you get these products in the market and until you get them trading with a track record, which we now have, that's when you can really see the product working.
Excellent. And this is classic leverage. It's not that daily 2x or whatever where this is just you're borrowing
Exactly.
money,
Yeah.
which means as interest rates have gone lower, that actually helps a lot. And I know this is going to be a question. So these are new ETFs. So a lot of these, they don't have the MER posted yet until a year, but the leverage costs are going to be included in that. So enough about the strategy and all that. Let's actually take a look at the names, and you could maybe discuss the why you decided to launch these particular names. So we have Costco, Netflix, Broadcom, Coinbase, Palantir, United Health Group, and of course this is new ones, but you have a whole list of them here. And I'm seeing, they're mostly, leaders in their field. They're big cap, US stocks, very liquid options. Maybe you could go through some of the names here, especially of the new ones, and why you decided on these ones here.
Yeah, absolutely. So we're very selective in terms of which names we launch because we want to really align the product suite around the central mission of appreciation in these long-term secular growth companies that are participating meaningfully to the upside. So we expanded this basket much more fully to round out the tech offering, in addition to adding more exposure across different sectors. And I think Coinbase, for example, is a particularly exciting one on the crypto front because we're seeing this massive movement where we're getting a lot smarter on the regulatory aspects of crypto. So key kind of pro-crypto minds are now being installed in the current administration, in which we will really get back to, I think, this time to build. And previously, when Gensler was the chair of the SEC, his MO was really to litigate instead of regulate. And
Yeah.
anything that provided a utility case really got regulated out of existence. And I think this is one of the grossest kind of overreaching periods when it comes to financial regulation, because it was completely legal to make a meme coin of a cat. Yet you would get sued if you did something pretty innovative. And an example of this was a company that we met with that was trying to build a transactive electrical grid that really enabled individuals to essentially trade electrons on a platform powered by cryptocurrency by plugging in renewables and really flattening time of energy use curves out. And this was banned. So if this sounds backwards, that's because it is. And we're really getting back to a period of building here. And that I think is going to be incredibly exciting innovations in the space.
Yeah, especially with the new administration in the US, which is a little bit more pro crypto and pro, let's regulate this instead of banning this, which is great. So that's Coinbase. You also have, another stock that's been in the news lately, like Palantir, which is all about AI. But then you got some more, what I like to call more boring, more classic stocks like Costco. Everyone knows what Costco is, United Health Group. Of course, you have Netflix, right? Which is the stock has been on a tear lately. I guess people just, subscribe and never cancel their subscription, including myself.
Yeah.
And then
Very
there's
good pricing power there.
Yeah, pricing power, exactly. And then there's Broadcom, which is like now in like right there in the trillion dollar club. So the
Yeah.
theme I see here is you got some interesting names for sure, like Coinbase, Palantir, but also some classic ones as well, which is
Mhm.
fantastic. Right, so investors could pick and choose their own, which ones they like, et cetera, et cetera. But this is the first time where you've launched kind of an all-in-one. You've called it YMAG, I believe, right? The Tech
Yes, that's right.
Innovators. And I'm sorry, I unshared my screen, but here it is. So this is
Mhm.
the stock symbol is YMAG, and this one includes the Magnificent Seven plus Broadcom, right? So tell me a
Yeah.
little bit about this one. This is your first all-in-one. Tell me about it.
Yeah, and a lot of people have really been clamoring for this basket. And a lot of the people I sit down with and I meet and we have all these conversations, they really wanted to get a much more diversified kind of basket. And this tech innovation yield shares is comprised of really this funny new acronym that people are talking about because we had FANG and then the
Mm-hmm.
MAG 7. And now we got Batman. So this stands for Broadcom, Apple, Tesla, Microsoft, Meta, Alphabet, Amazon, and NVIDIA. And the reason we picked these companies is for this basket is that they're really all at the forefront when you think about it of this kind of next wave of artificial intelligence. And I know it's the buzzword of the day, but I really do believe that every company that doesn't really consider itself an artificial intelligence company has to either buy a product from one, become
Yeah.
one, or they'll get left behind. And I think this really is going to change everything, and all these companies are doing it. So this company list is really a fully integrated stack when it comes to kind of this proliferation of AI. Because if you think about NVIDIA and Broadcom, right, they're the core players when it comes to providing the picks and shovels behind powering AI. And I think we would still be in this AI winter if it wasn't for the GPUs that NVIDIA produces that we can do all this fancy AI math on. Broadcom is also an excellent way to diversify the semiconductor play because the large cloud players are all starting to build their own chips, and they do this by partnering with Broadcom. And the next layer is that sort of cloud and software layer. So this is that Microsoft, Meta, Amazon, and Alphabet. And these cloud players have really been dominant forces when it comes to this digital transformation because they really effectively streamline productivity and act as really the central nervous system for all things tech. And if you look at AWS, GCP, and Azure, these three largest cloud businesses, if you stripped out any one of these from the core business, I think the standalone business would really be in the top 20 for leaderboard for market cap. So these are platforms that are really powering digital transformation. And the final layer is that end kind of hardware layer. So you have Apple, I think is particularly exciting because as a lot of these LLMs get cheaper and cheaper, like we saw that with that scare with DeepSeek, then what you have here is more compute being done on the edge. And Apple really skips spending about $80 billion on chips and instead wants to be the main touch point for all end users. And the partnership that they have in place really sets them up to benefit from this very well because they can partner with guys like OpenAI who provide the software, then run it on an Apple device. And then finally, we have Tesla. And I think if you approach Tesla as only a car company, you're thinking about this the wrong way. I think Tesla is a robotics and automation company. And if you
Mm.
watch the videos of their manufacturing floor, it looks like something from a science fiction movie. And the real world AI that they are building is nearly unparalleled when you think about it, because they have an existing fleet on the road with the largest database of real world imaging throughout roads and highways and sort of actions and responses. And training these AIs requires a huge amount of unique proprietary data, which Tesla has. And if they could properly convert on this advantage, I think the robo-taxi business will really be a smash hit. And additionally, I think where it gets particularly exciting is the robotics division. And I think within the next 7 years, everybody's going to have a fully functional humanoid robot in their house that can do all the chores we need it to do. And right now, China has this massive lead on robotics. But due to a lot of these security concerns of backdooring into these units, we need to have something built in North America. And so particularly exciting times ahead there. So just to wrap on that point, we really think that this basket provides really incredible exposure to all these cutting edge themes in this diversified way. And again, you get this long-term price appreciation combined with the monthly yield, and we're targeting the sort of 12 to 15% yield for this basket.
Yeah, we haven't. Thanks for all that, by the way. Really, it shows you're
Mhm.
really up to speed on these technology and AI companies, and I see why you made like
Mhm.
a technology slash AI basket here, and not let's just put all the yield shares we have. So maybe one question I know I'm going to get from my audience: why not just make a basket with equal weight all the ones you have? Why did you just select
Mhm.
those magnificent eight, if you will?
Yeah, because we really wanted to target exposure in terms of what people are are buying here. Because if you put too many different things into these baskets, it says, okay, how is this correlated with that? So if you want to bet on a theme overall, I think that by combining the kind of AI and tech focused ones rather than all of them really lets you bet on a pure play, direct play on that theme, rather than these other products that do not relate with that theme directly. And you can always just kind of layer in with in terms of how you're buying these individually, you can layer in those other products as well. So we really think that this provided that diversified exposure to that theme and also while keeping that pure play concept.
Excellent. Yeah, it makes sense to me. And I got a burning question. So you have Coinbase, just launched it, Palantir. I don't see
Mhm.
MicroStrategy. So how come there's no MicroStrategy? Or strategy,
Yeah,
rather.
oh yeah, they did. They changed it to the
Yes.
strategy. It reminded me of when in the Facebook movie where they say drop the on Facebook. Yeah. But
Yeah.
so he's now put it to just a strategy. But this really is an important question because we had this internally, and what we came up with here, and really we wanted to go back to kind of just why we put these products together. And we have to stick to our core beliefs in terms of these are not speculative instruments. So we aligned the entire product suite with companies that we believe can appreciate over the longer term because they ride these secular waves and they do this through sort of operating these cash flow generative businesses. And although I am very bullish on the long-term potential for crypto, I think you have to look at the structure and essence of what strategy or MicroStrategy really is. And this is a highly levered play on Bitcoin. So Michael Saylor can come out and attach all this fancy verbiage he wants around how he's doing a yield arb strategy in the public markets. But at the end of the day, when you add that much leverage to something, it becomes a lot riskier. And we prefer to have that exposure to either to operating companies like Coinbase or directly to the underlying, like our Bitcoin ETF. And by the way, Purpose launched the first Bitcoin ETF in the world far before all these US players came to market. And we also have a yield product on that lineup, which uses a volatility targeting strategy. So if you want a Bitcoin plus yield exposure, I'd take a look at that product instead of something that's a little bit more riskier with the leverage, like a MicroStrategy.
Yeah, like BTCY, what you're talking about. I owned it for a
That's right.
while. You have the Ethereum one as
Mhm.
well. And I also saw, very exciting, you guys are about to launch the first Solana and XRP ETFs as
Yeah.
well, which maybe I'll have you back and we'll discuss those because I have no idea what those are, and maybe you probably do. But it's a valid it's what I thought the explanation was going to be. I do agree that it's really a speculative stock now. It's a speculation. It's a
Yeah.
highly levered speculation on Bitcoin, pretty
Mhm.
much. So that makes complete sense. So you have, you know, you do have some competition in Canada now, in the US as well. But in the US, they're more like, let's write 100%, cover
Mhm.
100%. But in Canada, you have some competition as well. Who, fellow ETF providers launching these single names and all in one as well. What sets Purpose apart, would you say, from your competition?
Yeah, and I think this is important to address because we've seen some other similar products come to the market. But quite frankly, I think we've constructed a superior product when it comes to just the operational backend that we're doing. So there's some of these other products in the market that might print a fancier yield on the brochure, but what happens here are several things behind the scenes. So the first is that these other products might not use as sophisticated of an option strategy as we do. So as we mentioned, sort of in the opening there, we have that sort of 12 to 15 different legs of options underwritten across different strike prices and different maturities, where some other products might only have one option price, one option strategy at one strike price. And our strategy is much more really mitigates that price path dependency that I had mentioned earlier in terms of those strong bull markets where you get a lot more called away. So we really participate much more meaningfully on the upside. And another sort of thing that you might see other products do is distributing more than they're actually earning in yield. So what happens here is they distribute more than they're earning from their options writing strategy, and that capital comes out at the risk of holding less of the underlying security, and it might not appreciate as well over the long term. So we've really built a product in a much more kind of considerate fashion, and over the longer term, I think performance will really paint this picture well because at the end of the day, the only thing that you eat is performance, and I think your dinner plate's going to be much more full on our product versus the competitors.
Makes sense. And covered call ETFs, that's my world. I've been in it for a long, long
Mhm.
time, and I've noticed that there's a lot of misconceptions. There's a lot of bad information out there. Although I think it's getting better
Yeah.
and better with time as people see, okay, how these ETFs perform. What would you say is the biggest misconception about these type of covered call ETFs or the covered call strategy in general?
Yeah, I think that some investors might kind of do their initial process in terms of focusing mostly on the coupon and the yield instead of just thinking about the total return profile. So you have to think about that longer term uh, total return profile because you want to have sort of a buy and hold strategy while generating while generating that monthly yield. So some similar products that print this higher yield are giving up much more upside
Of
over the
course.
longer period. If the percentage is bigger than 50% or they're writing closer to the money. So I think that the investor sort of education and information that's getting put out, especially by your channel, is really helping people frame that in terms of thinking about the longer term and avoiding some of these pitfalls that you can see.
That makes complete sense to me. Yeah, I tell people all the time, yield is not return. It's very important for people to
Mhm.
understand that. So who do you think these ETFs are best suited for, designed for? What kind of investor do you have in mind for these?
Yeah, for sure. So we've seen massive appetite for this product really across the entire spectrum of the investment community. And with the introduction of our tech basket, I think we now offer more exposure for those that want a diversified approach, as well as those that like to pick stocks and hold individual securities. And the retail community has really loved this product because it provides that yield plus the upside. And we're starting to also win a lot more in the group of investors that likes to deploy very kind of operationally extensive option strategies themselves. And these strategies really require constant rebalancing. It can be a little bit
Hmm.
of a headache, but what we do is we combine everything into one simple and easy to use product. Everybody can really see the immediate benefit of the complex stuff we're doing on the back end. And it's also a very tax efficient way to earn yield because it counts as capital gains rather than distributed income because we directly own the underlying and the options are considered a hedge instead of speculation. So this makes our product really great for every type of investor, which I think is really resonating well in the marketplace. Whether you're just a long only investor or you're very experienced with options, we find that wrapping this all into one product has been extremely effective.
Yeah, that's a very important point that we've discussed in a previous video, but just in case, audience is not aware of it, these are covered call premiums in Canada are considered capital gains, right? So they're
Yes.
very, very tax efficient. And especially on, there's a lot of these stocks don't have a dividend at all, like Tesla and a lot of
Mhm.
the new ones you've launched. So it could only ever be capital gains and or rock because those stocks don't have a dividend. So very, very tax efficient. And I just have a quick question. This makes me think now, some of them do maybe have a tiny dividend, maybe like a United Health Group. So would a tiny portion of it be, I guess, foreign income because it's a US dividend on those names? Or can we expect a small portion of foreign income, or is it all going to be capital gains and or rock for these ones as
So
well?
there is still that dividend component because we do own the underlying security itself. So that's right in terms of we are still getting paid that dividend, but this
Yeah.
adds that kind of extra yield on top of it. Mm.
Okay, sounds good. In terms of member questions, so there's a few member questions that I'd like to cover. We covered a lot of them. A lot have been around the distributions. So for these new ones here, if we just look at, for example, the Netflix one, but you could look at all of them. There's a first estimated distribution. Can you tell me about what your distribution policy is? Because, for example, if we look at one that's been out for a really long time, like Tesla, and we look at the distributions, we could see fairly stable distribution, but sometimes they go up or sometimes they go down. Like recently, when Tesla was on a run, it was at something like 30 cents a month, then it went to 35, then 40, and then it dropped back to 30 cents when Tesla stock took a big hit. But now,
Yeah.
obviously, Tesla's been going back up. You raise it to 55 cents. So tell me a little bit about what kind of distribution policy, what kind of distributions could people expect on these?
Yeah, for sure. And this is a very important point because the
Yeah.
distribution is not going to always be the same. So the one function of that is which exactly what you touched on in terms of the price of the underlying itself, either appreciating or depreciating. So the distribution amount itself
Yeah.
will vary around that in terms of because we do have a target percentage. And so what we have is we want to really maintain that target percentage of distribution. And in any given period of time, what you're going to see in this options market is that implied volatility changes. So when the implied volatility of the underlying security changes, that affects the call premium that you are generating. So in periods of high volatility and high implied volatility, that's when you write the call strategy and you're getting more yield. So, and in periods of lower volatility, that's when you'll get a lower yield. So the distribution will vary, but we do tend to keep it in a very close range. So that's why you're seeing some variance on the period over period basis, is because that change in the implied volatility of the underlying.
Yeah, I trust you guys are very, very responsible. And I think my audience members know now that covered call premium is based on volatility. The more volatile the stock is, the higher the premium, right? This is why probably you'll expect a little bit higher yield with the Coinbase and the Palantir, for example, versus a Costco, right? Costco's a little bit more boring
Exactly
stock.
right.
But NAV also is a factor as well. And another question I've got is regarding the MER. So obviously, I definitely could answer this. For the new ETFs, you're not going to have an MER for a year. But another thing you got to remember is that the leverage cost will be in the MER. So if my audience members has any questions about the MERs, my advice to them is maybe check past ETFs, like the Tesla one that's been out for a long time. You could actually see the MERs there. And these are approximates because remember that because leverage costs are a big part of it, it's based on interest rates. So if interest rates go down, well, that has a positive impact on the MER, but you might not see it updated on the website right away. It might be next year. So I keep getting these questions about MERs and why are they so high? Well, listen, leverage costs are included in there, but leverage costs are pretty low right now, which is fantastic. So that pretty much sums it up. Another thing for the covered calls, you talk about different legs. And if you guys go to portfolio breakdown, I'm talking to my audience here, Nick, you could actually see, and this is what I really like about Purpose website, not many people do this, you actually show where the moneyness of the covered calls on it, and you could clearly see that, you know, there's some calls that are 12% out of the money here, 8% out of the money, 4% out of the money, so you could actually see the moneyness of the options live, which is pretty cool, and how many options are written. So this is really cool. So if you guys are curious, you could always check out the portfolio breakdown for that. So I think that pretty much sums it up, Nick. I'm just going to check if maybe I have other questions, but most of them were the MER, the target yield on each. I don't think you guys have, you have a target yield. I think you mentioned you had a target, but it could fluctuate. Is that correct?
Yeah, that's right. So for instance, like with a Tesla, for example,
Yeah.
it can be sort of anywhere between, call it 17 to 25% percent range, depending on the implied volatility of the underlying. So we do have these kind of target ranges, but again, it is going to vary as the volatility environment changes. So a Tesla or an Nvidia, much more volatility there, and we can pick up much higher. But the other ones, in terms of lower volatility profiles, will be that lower range in the kind of 5 to 8% range.
Awesome. And these are all current, you know, these are all US stocks so far. They're all US stocks. They're all currency hedged to the Canadian dollar, which technically means if the Canadian dollar is getting weaker versus the American dollar, like what's been happening in the last 6 months, this will negatively impact the fund a little bit, whereas the opposite would positively impact. So I'm just curious, are you guys maybe thinking of launching unhedged versions? Why are they all hedged to CAD? What made you come up with that decision? Is there any plans for an unhedged version or maybe even .U versions as well? Because I know some people are interested in buying them in USD currency.
Yeah, for sure. So we just wanted a very sort of straightforward and easy to use product when it came to just being able to buy it into your brokerage account with Canadian dollars. And we wanted to kind of handle that hedge back to Canadian ourselves and really make that, again, one of the features of the product of wrapping all these individual features into something very easy to use in one product. As of current plans right now, we don't plan on launching the US dollar ones just because we have had so much success to date. And we're now north of around 550 million in AUM across the product suite. So we don't have the plans right now to launch those, but we love the sort of feedback from all the investor community. And we have these conversations all the time because we really want to put out all these products that fit exactly what the investor wants. So any of this feedback, definitely pass it along. And we like to consider that as we kind of introduce these new products and as we adjust our product suite to really capture exactly what investors want. So definitely appreciate all feedback around that.
Yeah, you guys are all have always been very open with that, and you could just go on the Purpose website, guys, if ever you want to send them an email or some or offer some feedback. Trust me, they
Mhm.
they pretty much read everything. Perfect. So Nick, you've been great. You've answered all the questions. I think we covered everything, and I encourage my audience members, in case they haven't seen it, see the previous videos because we go a little bit deeper. We talk a lot about, the cover call strategy and other things, which we've touched on a little bit today, but we wanted to touch on other things. So Nick, thanks so much for doing this. Really appreciate it, and hope to have you back again soon.
Thanks so much for having me. Really appreciate it. Take care.
Take care.